Well, welcome to Getting Rich with Rich. I'm Rich, founder of Under the Radar Report. This week, I can't go past arguably the biggest news in markets this year, the 50 basis point cut by the US Federal Reserve. Well, I'll talk a bit about what that means, which is outlined in our Blue Chip Value report this week. Then I want to talk quickly about risk, because the key to managing money is understanding risk. And that's what we focus on at Under the Radar Report. So the rate cut was the most anticipated rate cut in living memory. And markets moved well in advance of the rate cut, sort of pricing it in. And that's why, when it actually happened, markets sold off, albeit only slightly. But there's been huge rallying in both the equity and bonds markets. So the big takeout for mine was the need to diversify your portfolio. Like really, really big takeout, diversify your equities portfolio. Like some might say diversification means fixed interest, property, equities. For mine, the money has been made in fixed interest, like bond markets have rallied. Really, interest rates are not going to go back to zero. How much more money can you make in fixed interest? So that's fine if you're just happy with a flat sort of return. But, if you want growth, you need equities. To maintain your standard of living, to pay those debts, to pay those mortgages, you need growth. You can't just adopt a standing still policy. And to do that, you need a balanced portfolio of stocks. You need to diversify. So what does diversification mean? So we organize our stocks sector by sector. So there's one big clue. You also want diversification by capital structure. So we're careful not to pick stocks overburdened by debt. There are companies that can get away with debt, like I've made a lot of money from Northern Star, Evolution Mining. These are gold stocks. They could take on debt. They had big cash flow and they could pay down that debt. So in that way, they got more leverage. But not all companies have a business model that can do this. And if you're weighed down by debt, it can really stop you from growing, can stop you from doing things. Like basically, debt is a big stopper. Like any fixed cost that just rolls in and rolls in and rolls in, if you haven't got a handle on it, then you can't grow. So one example in our blue chip report this week was Insignia, previously called IOOF, like Financial Services Group. Basically, these guys cut their dividend, and like the result of investors was like they put their hand, in boiling water. They took it out quickly and they sold IFL, quick, smart. Why did they cut their dividend? They cut their dividend because their debt was too high and they couldn't be assured that the growth they were going to get from those two massive acquisitions that they made. I think that ANZ Wealth and there was another one, MLC. So they made these two big acquisitions. They were overburdened by debt. In order to get the benefit from those acquisitions, they needed to hold their firepower. They needed a balance sheet that was strong. So the other thing that we look for in terms of diversification is customer diversification. Like I mentioned customers a lot when we're talking about our stocks. And one of the reasons Austell went, up 25% this week is, returned something like 70% this year. And one of our favorites is because it's got gold-plated customers. It's got the US Navy on its books. It's got the Australian Navy. It's got huge barriers to entry. But on the other hand, it has big cash flow problems because, there's a big investment that they have to make in order to, transact these big contracts. They're big inventory requirements. So there's a lot of risk on the other side. But, this is what you can get from low customer risk. You can get these kind of advantages that other companies just don't have. Like last week, I mentioned New Zealand Media. NZM, that's another company that has gold-plated customers, like the biggest customers in New Zealand. So this is a factor you want playing a role in your portfolio. So rounding this out, like in our small caps publication, we cover off on the balance sheet, the cash flow, the profitability, and the absolute sales levels, as well as customers in one figure. That's our risk rating. So it's really worth checking out. So we do all this homework because understanding risk is really important, whether it's a small cap, whether it's a big cap, whatever the company, understanding risk is the crucial factor in being able to determine what role it's going to play in your portfolio. So like speaking of that, like I've got laggards in my portfolio. Like I've got Max 7, M7T is the code, Laser Bond, a manufacturer. Like I've got these laggards, but let me tell you, they have a high risk rating. Like, they're up near the top of our risk rating. So they're, 1 is the lowest risk, 5 is the highest. These guys are 4 on our risk rating. So as a result, my exposure is small. Like it's okay to have stocks in your portfolio that aren't doing well. Buying these stocks is not the same, the ones I mentioned there, is not the same as buying an Austral or a New Zealand Media. They're higher risk, and this is reflected in our risk rating. So portfolio management is all about limiting your exposure to any one stock. Then as they do better, you can think about buying more. Some small caps are under the microscope more than others. That's what I'm saying. Like managing a portfolio is like coaching a football team. Each stock has its role, but they also have to prove themselves, no matter what the potential. Like that's why you should read our risk rating. Look, I can never emphasize this enough. You've got to be in it to win it. Like you want to get in these stocks before the big announcements like the Austral announcement. You want to get in there before, you want to have irons in the fire. But you want to have a balanced portfolio, and this is where we help. Next week, what have we got coming up? The banks, arguably, all they do is manage risk. So we've got a special report for our blue chip members. So this week we come out with our 100 plus research rundown in small caps. So this gives you a good once over for each small cap. So you need this to manage your portfolio. It's been great talking to you again. Looking forward to talking to you soon.